Hello everyone, my name is DK Joshi and I'm the Chief Economist at Crisil. Many thanks for joining us for this webinar on such an interesting topic, US elections, promises, policies and the aftermath. Special thanks to Dr. Bethan Bovino for making time for this webinar, and that too on an early winter morning from New York. Bethan Bovino is US Chief Economist at S&P Global. Before joining S&P Global in February 2004, she spent over 10 years doing economic and market research with SunGard Institutional Brokerage, UBS Warburg, and also the Federal Reserve. We will have a PowerPoint presentation from Bethan, which will be followed by a Q&A, which I'll moderate. May I request all the participants to submit their questions through the Q&A box in the Zoom webinar window that they see. So without much ado, over to you, Bethan. I think you can load your presentation.
Thank you, DK, and thanks everyone for having me. It's great to be here on this. You might see me drinking my coffee while I present. I hope that doesn't interfere, but it's great to be here. Here are my slides. Hopefully they're popped up. Can you let me know if you see them?
Yes.
Great. Okay, so where are we? Before we get into the politics of the United States, it probably is best to sort of get a sense of where what the new president is up against. And to give you a sense of that, it's pretty challenging. Hold on, I'm trying to, there we go. Overall, the pandemic, it had ended. The recession ended at the end of, that we believe, sometime in May. However, the recovery is rather slow. And as we know, in the United States and many parts of the world, such as India, the virus isn't through yet. Indeed, the virus seems to be coming back for a third round in the United States and certainly in Europe and other parts of the world. The US hasn't necessarily shut down dramatically. It seems there's a reluctance among policy members to reclose businesses and shutter homes. But still, it's causing a response from the households in terms of their activities, buying activities, and getting activities outside. So let's go through a little bit of what happened. A lot of this will be not new to you. We had a massive adverse shock. It was driven by COVID-19 and the quarantine that went through. We saw in the United States, we saw a huge drop of activity and employment. It was unfounded. We hadn't seen anything like this since I guess the Great Depression. We saw also an unprecedented policy response earlier on in March and even in May, both on the fiscal side and on the monetary side. And keep in mind that only 2 months before the US went into complete quarantine with 90% of households working at home, we were going through an impeachment process. So obviously the tensions between the two sides of the government in the United States were not on good terms. Still, they moved quickly and they gave life support where it was needed. Now where we are at is the economic outlook going forward, to where we are today, depends on an interaction between mobility, depending on what happens with the virus, restrictions, and of course the speed of reopening and the speed of the vaccine. Will it get out and when? There's a lot of questions we have, and these are certainly our downsides. What will happen with the fiscal stimulus? We know that the Congress is debating this right now, and we don't expect much to get done until the election, and possibly not even after, with the way the two sides are so far apart. And we also have, aside from this, we still see it. We see the virus starting to resurge in certain parts of the United States, and with that, the last point I want to make is that we also have the trade dispute heating up with China. Those three risks are why we have a downside risk to our assessment, with a recession risk of 30 to 35%. All this depends on the virus. The duration of the virus is and how long it lasts is what makes this outcome worse. Indeed, because the virus has lasted so long, we've already started to see policy fatigue set in, and the scarring is also setting in as well. We'll talk about this in the next slide, but particularly what's happening, we see this in the jobs market. temporary jobs, what were considered to be temporarily job loss is now turning into permanent, meaning that the scarring could be deep. We never thought a V-shaped recovery was in the works for the US. We were largely thinking a U-shape with a slow, long bottom for this recovery. But of course, the longer this lasts, the risk that it does to balance sheets, corporate balance sheets, and with that, an L-shaped recovery couldn't be ruled out. All this says is that the US president has his work cut out for him. I talked about the jobs market. Here's a good sense of what we're looking at in the US. Things have gotten improved, that's for sure. The unemployment rate in the United States, if you look at the left-hand side, it hit almost 15% in April. That was a number. That was a number that we had not seen going back through the history of the monthly data, which goes back to I believe 1939. Never seen before. We've also seen it come down dramatically. That dotted line that you see on that slide is the 7.9% number that we have currently for the unemployment rate. Certainly a big improvement, but I don't think it's time to pop open the champagne just yet. That 7.9% unemployment rate that we have for the United States is equal to or higher than 8 of the last 11 recession peaks for the unemployment rate through 1948. That's still very high. And to me, that still feels like recession territory. And I mentioned earlier some of the structural concerns that we're looking at in the US. On the right-hand side, what you see is you see the breakdown of total unemployed, whether they're temporary or permanent. The dark blue was temporary unemployed. Very much that was the huge hit that we saw in April. The hope was that they were going to come back once the doors open wide. But what we're seeing is while some of them are coming back, many of them are no longer, they're still unemployed, but they're becoming what would be considered permanently unemployed. And that's that yellow line that you see, which now makes up over 30% of US unemployed people are now permanently unemployed. That we also see that in the people who are unemployed, how long they've been. Now over 60% of those people who are unemployed have now been employed for 15 weeks or longer. They're going into the long-term territory. And when you go into long-term unemployed, for whatever reason, it's very hard to come back. Either your skills atrophy or businesses assume they have. And this is a challenge as well. Down at the bottom is one of the reasons why we saw this. We saw many businesses go under, many businesses close shop permanently. On that line there is 60% of US businesses, according to one survey, and that survey is very large in terms of the number counted. 60 of those US businesses that had closed temporarily are now permanently closed. With the virus, if we see another resurgence of a strong virus and also quarantine, the worry is that those businesses that did survive the first round may not make it the second. Now, some of the numbers that we're seeing have improved. In fact, we do something looking at non-traditional real-time indicators because the virus is so fast. Some of the traditional data doesn't really keep up. So what we look at when we look at non-traditional real-time indicators, what we've seen in those, and it covers a vast array of indicators across all sectors. And what we found is that most of these indicators have found bottom. Some have improved. Indeed, some of the indicators that are tied to goods business, either manufacturing or construction, have improved pretty nicely. And we've certainly seen people spending a bit more with US consumer spending actually at or above pre-crisis levels, but it depends on what they spend on. We've seen consumer spending on durable goods, big appliances or furniture for their new office that they've had to create. But what we're not seeing spending on is on services. And here's a good example of how weak services have been already several months into the recovery. Air traffic in the US is pretty much dead, a little bit here and there. Why is that? People have canceled their vacations, so nobody's going anywhere. It's a stay vacation from now on. But also businesses have canceled a lot of trips. Why have businesses canceled trips? If you go from, for example, if I get sent to Colorado, When I come back, I need to quarantine for 14 days. Not very helpful in terms of getting business operations. It's easier to do something like this, like a webinar instead. On the right-hand side, that also plays right into it. Hotel occupancy are now, I guess you can see for RevPAR is about maybe 40% below year over year. Hotel occupancy is also well below, to give you an idea of the weakness that it's facing. But if you want to find a V-shaped recovery, it's in housing. Why? People are staying home, and another reason, and so they want to live in a nice place. And so that's one reason. Another reason, interest rates are so low, there's opportunity there. And further, because of much of the Federal Reserve's action in terms of getting liquidity out to markets, equity markets are so strong. At least, I guess, as of yesterday, we're a little bit weaker, but are incredibly strong. And so that, in a sense, helps prop out the housing market. On the left-hand side, how retail sales, you might have seen some of the numbers in the United States that have been so strong. A lot of that is also driven by housing, either buying furniture for the new home you bought, or fixing the home that you now plan to stay in a lot longer because of the quarantine. That's not just fixing up the furniture in your living room, that's fixing up the garden that you now may be spending more time in, or buying furniture to turn your bedroom into your new office, since you're going to be working virtually from home for a bit longer than you had thought. On the right-hand side shows how home sales have been incredibly strong. That indeed is one V-shaped recovery if I ever saw one. We're also seeing in this line, we're also seeing some improvement in the private sector. Crude oil in the U.S. is one of the largest, is now, I believe, a net exporter of energy and the largest producer of energy in the world. It matters to the United States recovery. On the left-hand side, crude oil, this is, I think, through early October, and the numbers, this is West Texas crude, the number seems to show that it's been holding at around $40 a barrel or around there, a little higher, a little lower. And with that number, that's still below break even for most US energy companies. Usually break even would be $45 to $50 a barrel. Good news is it's no longer at $15 a barrel, so some companies can survive, but it's still below break even, suggesting that investment in that sector will still be rather lackluster. On the right-hand side, you can see sentiment readings holding up relatively well, both for non-manufacturing and manufacturing. They're all above 50, which indicates expansion after a huge hit earlier on. When the shops were closed. What we're seeing here is a kind of a divided kind of a two-tier recovery, I guess you could say. Manufacturing and goods-related businesses are doing rather well. Construction incredibly well, and with construction doing rather well, the materials that go into construction, either the furniture or the appliances or the electronics that get built out when you build a new home, are also doing rather well. The service side of things is still struggling, and that's an area that where we see continued problems. Now with the government, a quick point on the government and where we are today. This will lead right into what we expect from the elections as we get to that. The U.S. government, I mentioned that the U.S. government had moved very quickly in terms of getting liquidity out to, getting liquidity and support to those in need. On the Fed side, cut interest rates to near zero, started to go to the so-called alphabet soup of facilities to get liquidity out to markets. They started to intervene into commercial paper, money markets. They even started to buy corporate bonds, first investment grade and then high yield. This all supported liquidity, and it really did calm markets. Indeed, markets started to function reasonably well sometime in April, and that was a real surprise. And they've also loosened the market prudential conditions. That was needed to ease capital burdens and allow banks to absorb and absorb the shocks. That fed very nicely in what the U.S. Federal government was trying to do, particularly with PPP, the Paycheck Protection Program, getting the banks out there to support that policy. The last thing they've done most recently is the new monetary policy strategy. We find this very meaningful. They're allowing now a temporarily inflation overshoot, meaning that they wouldn't budge on interest rates if, say, inflation held above the 2% target, maybe a little bit, maybe 2.1 or even 2.2 for a few months. That's very meaningful. And they're also indicating a lot more accommodation with the jobs market, focusing on not just the headline numbers, but how it reaches across all parts of sectors in the households. On the right-hand side, the fiscal side, they moved very quickly in March. They got a lifeline to households and businesses in need. But now there's no agreement on extending stimulus. And I can tell you where we are right now. Viral cases are rising. The people that are unemployed already, we're looking at about 11.6 million people. But that's not just people who say they're unemployed. Many people dropped out of the workforce. That adds more. For example, that 7.9% unemployment rate, if we added back the people who dropped out of the workforce since the epidemic starting in February, that unemployment rate would be closer to 11%. So there's a lot of people hurting. That's why we do see the need. The need is very, very, very much a concern. And indeed, the line right below, the risk of mistakes are very high and extremely costly. If we go to the next slide. These are my overall forecasts, giving you a sense of what we're looking at. The light blue line is our base case. This is where we're expecting for the U.S. And indeed, funnily, we had an optimistic scenario. We had a forecast for our baseline that was optimistic relative to what the other private sector economists were thinking. At that time, we had a 5% drop in 2020. Turns out our baseline forecast was even too pessimistic. Now it looks like we're going to see a drop in GDP around 4% in 2020. But unfortunately, a lot of that was just pulled back from 2021, meaning that the next year is going to be rather slow. We are not expecting to get back to pre-crisis levels until the end of 2021. And something that the Fed is going to watch very closely is that the unemployment rate, according to our analysis, won't get back to pre-crisis levels until sometime in 2024. We don't think the Fed's going to raise rates until sometime late in 2024. It depends on what happens with the jobs market, but particular that inflation rate, which has remained so well below the 2% mark, we don't expect that to finally peep above 2% until sometime in 2024 as well. That gives the Fed a lot of time to wait with accommodation for the markets. The three risks that I mentioned for the U.S. economy are right there in the second bullet. And with that, we do have a downside. That's that dark dotted line. That's the double dip scenario. Assuming that the National Bureau of Economics does call the end of the COVID-19 recession in May. What we have in our scenario is that COVID-19 cases flare up, which we are seeing right now. Second condition for a double dip, government stimulus. That bridge that got us, was to get us to get the economy to the other side, only makes it halfway. Indeed, no stimulus is available. And what we see from that premature austerity, the GDP will drop now by 5%. With a very slow recovery in the next year. Now, in terms of what does this mean for the presidential election, the economic impact of policy proposals. First, I want to take a couple steps back here and say, despite the ugly rhetoric, surprising similarities in the policy proposals between President Trump and Vice President Biden. That's for trade and infrastructure. Unfortunately, the similarities end there. The policy proposals for taxes, healthcare, regulation, and immigration are far divided. And that's where the tensions are certainly rising. In terms of, but we also want to remind everyone is that promises are not policies. We don't expect to see, big structural changes depend on the congressional makeup. That means who has the majority in both the Senate and the House. There's talk about what is the so-called blue wave in the United States. That would mean that if Vice President Biden does win, would he pull the Senate and the House with him, meaning a majority Democrat in both parties? That would give him a lot more leeway and to get some of his promises through. But I still say The big issue for the president and the first task on day one is going to be steering the American population and the economy back to health. That means that the administration, Congress, and the Fed will need to work together to get the US out of a potential downturn as this recovery has been slowing. That would then, that's where additional stimulus would be needed to bridge the next stage of the recovery. I would say that if indeed President Trump wins, I suspect that he will have a divided Congress, meaning that the House will stay Democrat, but the Senate would probably lean Republican with him. That means with a divided Congress, the struggles for the president to get some of these policies through would be very much a challenge. Anyway, the harsh reality is that this next president will have his work cut out for him. I have a few more slides. I don't want to take up all the time, but let me keep going. I guess I thought I had one more slide. Page down. I do, okay. Couple little things that I wanted to point out. I mentioned that trade, they're both in an agreement. Both seem to agree that the fight with China is still not over. They're taking different tacks though. What are the reasons what we're looking at? Right now at this point, the phase one deal with China has pretty much stalled. You're looking at the dotted lines or the commitments that that were made in this agreement in terms of US exports and Chinese imports. What we can see here is that it's about 1/2 to 1/3. What has actually been purchased is 1/2 to 1/3 of what was promised. And indeed, that has stalled. But the issue here in China is not necessarily about, between China, is not necessarily about the tariffs that are in place. If you look at this chart, we put tariffs at the bottom, at the end. Why is that? Because it's the least important in the long run. The two other factors that are playing right now: investment restrictions on businesses that want to do business in the U.S. and export controls on what gets sold, particularly on technological products from the U.S. Right now, those are the two factors that are playing well and high, and those would be called non-tariff barriers. If we see that that continue to happen, it does have certainly a short-term hit to U.S. businesses, but it has a long-term hit as well, meaning that it affects the opportunities that business opportunities and productivity going forward. We think both President Trump and Biden will take this tact. And I don't think this is going to be ending anytime soon. Indeed, I don't think the tariffs will go out in the near term, even if it is a Biden win. On another piece of news about the U.S. recovery, one thing that we also find is positive is both presidents are focused on infrastructure. Vice President Biden seems to have much more of a plan right now, much more detailed plan, I should put it that way. He's talking about a $2 trillion investment in infrastructure, which surprisingly is something that we at S&P Global had modeled several months ago. But it seems to be fitting right now. If you look at this, this is giving you an idea of what the shape of the U.S. recovery is. On the left-hand side is what the shape had been earlier on in several earlier recessions. And the first two, 1990 and 2001, got back to pre-crisis expansion, but not the last two, not the Great Recession, and certainly not what we're in right now. What we see as infrastructure, the productivity gains that you would see going forward would actually shift the path of the expansion closer to the pre-crisis expansion to improve things going forward. Hold on. I think I'm going to finish up with this last slide. This gives you a sense of what we're looking for. These are the the election proposals and the impact on the economy. A couple of points I already mentioned infrastructure. The bottom is on immigration. Immigration, what we've seen, there's two different tacks there as well. President Trump will take a much more harsh stance on immigration, both on non-documented workers as well as on legal immigration, meaning H-1B visas. Whereas Vice President Biden is taking a much more lenient approach. He still is going to fight. He's still going to be restrict on undocumented workers, but he's talking about a path to citizenship for some of those undocumented workers who came to the U.S. The second thing he's also talking about is expanding employment-based visas, meaning H-1B visas and others. We had found earlier on that the impact of an employment-based immigration reform would add about over 3 percentage points to real GDP in the next over the next 10 years, or 30 basis points a year. Something nice, given that we're going through a very slow recovery. And the last thing I want to point out too, on taxes. We know that President Biden has promised to raise taxes in the US. Something particularly on corporations. Nobody likes taxes, and that certainly is a hit. But one thing to keep in mind, under the Trump presidency, the statutory rate for corporate taxes was at 35%. He brought it down to 21. Vice President Biden is talking about clawing back half of those benefits, bringing it back up to 28%, but still well below where it was pre-Trump. Meaning that yes, that would be a hit. But those who benefited from the Trump's tax package would still benefit, but just a little bit less. DK, I'm going to stop and pass it to you.
Yeah. Thanks very much, I think, for that very comprehensive presentation. I think that sets the stage for Q&A. May I request you to, I think, if you can stop sharing, then I think you'll be visible to the audience as well. So I think let me start with the first question on the elections itself. So I think there is an uncertainty with respect to the outcome, which always is there with any election. What is the earliest date by which we'll come to know who the next US president is, and how long that date could stretch? I think, and does the delay in announcement of the next president have implications for US economy and financial markets? There's just a new audience question. Let me attach it to this question itself. So can we see a repeat of 2000 elections where Supreme Court had to intervene? I mean, if it gets too close, then there is recounting, etc. What are the possibilities of such scenarios emerging?
Well, it certainly remains to be seen what will happen. I can tell you right now that there is a massive massive move to vote in the United States. I don't know what the ultimate turnout will be, but there is a lot of opportunities now that weren't available 4 years ago, meaning that they've provided early voting. That's something that, for example, in New York City, we did not have. Now we have it. They've provided more mail-in voting. Something that many states did not have before. Now we have that. And so we're seeing a lot of activity and a lot of people who may not have voted otherwise coming to the markets. So that suggests, if that is the case, there's certainly a lot of passion in this presidential election. And that would mean that, given the amount of people that are planning to vote and have already voted, what we suspect is that because the people are being heard, the final outcome will be legitimized by the fact that it was such a huge turnout. That's one thing to take into account. The second thing to take into account is how the vote happens. Now, I do see that if it is a very close election, then it becomes much more complicated. It becomes much more, meaning that, say, right now the polls are saying that Vice President Biden will win. But let's say it's a very close election, meaning that Biden only gets a slim majority. That leaves the question of legitimacy of the outcome a challenge, and something that the losing party, President Trump in this case, could challenge. That could mean a very slow determination of who won. However, I think that if that is the case, if we do see a very close election and a challenge from whomever the person who loses is, then what we expect to see, in my mind, it will be weeks, not months. I suspect it would take, and so in that sense, by when we get to January 21st, when the next president is put in power, we'll have this resolved. It's not good for markets. Markets will not like it, but I do expect to see a lot of volatility if that was the outcome. But I don't think, in my mind, I think it won't last that long.
Okay. Also, I think I was listening to you, and I think in your presentation, I think it became evident that the US is in need of another stimulus. I think Particularly, I think you mentioned that people might, the permanent job losses could increase, I think, going ahead. I think the way the virus is playing out. But I think after the CARES Act, which was passed very smoothly, 2.2 trillion stimulus package in March, there has been a discord over the next round of stimulus between Republicans and Democrats. What would a delay in stimulus 2.0, let's say, mean for the US economy and specifically for your forecast for 2020 and 2021 of GDP?
So, so right now we had, when we were doing our analysis and our forecast, this is back in September, actually August and September, excuse me. We earlier had the expectation that we could see maybe a $1 trillion policy and stimulus get through. But because of the disarray and pretty much the tensions between the two parties, it looked very, very much like that wasn't going to happen. We did think when we came to a final assessment of our forecast, we did think that something would get through, that there would be some agreement between the two members. And so we had a small package of about 500 billion. That would be enough for a little bit that would be enough to get through the hump if it was a short, Otherwise, if we look at stimulus as the bridge to the other side, as long as the ravine is not that wide, we could get there. The worry we have right now, even with that 500 billion that we have in place, is that the ravine could get wider, particularly because we're seeing COVID-19 cases pick up. The virus is picking up, and that means the quarantine and quarantine and other risk in terms of hospital factors, hospitals being stressed to the extreme could also play in. So that's one worry. Another worry is, so right now we have 500 billion in our forecast. It's becoming very unlikely that it's going to show up in the fourth quarter. Maybe at the end of the year, when the continuing resolution, meaning the government decides whether to keep itself open, is in play. But it's it seems even there, it's at risk of not showing up at all. That would put a challenge to our fourth quarter GDP reading, which we have at about a very low number at 3.5%. It would push it probably closer to 0. I don't think it would be enough to push it underneath unless the virus becomes that much worse. However, there's another area that we worry about in terms of the jobs scenario. The two areas that are being really challenged. First, it was the unemployment benefits. That seems to be reaching some agreement. The big challenge right now is stimulus to the state and local governments. That's a real big challenge. And there, given that those businesses, those state and local governments have been strapped by two ways: no revenues because people had lost their jobs and business revenues had collapsed and business profits had collapsed. But the other reason is because costs are high at the state and local level, dealing with unemployment insurance and all other kinds of costs that go involved with keeping their economy healthy. So with that said, budgets are squeezed on the state side. If they do not get stimulus, as they go into the planning for the new year, what we can expect there is more budget cuts on the state and local side, meaning more jobs lost, and that adds just to the problem.
Okay, thanks. I think moving forward, I think in your recent paper, and I think this has also been an audience question, I think you had talked about the similarities between Mr. Biden and President Trump. I think, but and also about the differences and the big gap between the two approaches of the two contestants, I think, is that they have very different views with respect to corporate tax rate. Mr. Biden said that he would, as you mentioned, would claw back about 50% of the corporate tax cut under the Tax Cut and Jobs Act of 2017. So does it not create uncertainty with back and forth on taxes? I think does it have, I mean, does this uncertainty have implications for corporate America, particularly with respect to private investments, because I think everybody wants a stable tax regime?
I think it's funny that you would think when you have a Democratic presidential contender talking about raising taxes, and you would expect to see markets respond negatively when that presidential Democrat contender looks like at least in the polls, is going to win. But what we're seeing is a positive response from markets. And I think there's a couple of reasons why the response for that a positive response among equity markets, particularly equity markets, that there could be a Biden win is for a couple of reasons. One, President Biden is also talking about stimulus. He's talking about significant amount of stimulus for for one, to get the economy to the other sides, that bridge. He's going to build that bridge. It's not only going to build a bridge to get to the other side from this, this virus-related recession. It's going to be a super highway. And in that sense, the money in the stimulus suggests that this recovery will not falter. It will pick up. So that seems to, market seems to approve that. Another reason is there's so much uncertainty when it comes to the President Trump's administration. Lots of uncertainty, and that uncertainty in terms of what will be tweeted next has caused a lot of panic, I think, sometimes among markets, and that's a worry, and they don't like that. They want certainty. And the third reason, even though they don't want to see taxes, they don't like the fact that Biden is even raising that subject, it is only half what they had gained. It's still not bringing them back to, they still have half of what was won in the Trump tax package. And fourth, the last one is that they know that the new president is going to be dealing with the virus and the stimulus. The tax package is going to be a longer time, is going to be pushed out later and may never happen at all.
Yeah, so in that sense, I think it doesn't create uncertainty in the current period, at least till 2022.
Exactly.
Yeah. So I think other question which we've just received is with respect to the role of the Fed. I mean, we've seen negative interest rates in Europe and some other advanced countries. So is there a likelihood of negative interest rate in US? And if at all, what could be the triggers that could lead to that?
The Fed has been actually Fed Chair Powell had been very clear. This was most recently, not just a month ago or 2 months ago, saying that it was unanimous among voting members of the Fed that they don't want to go down the negative interest rate route. They find that the complications and the issues and in a sense, the damage that it does to private sector incentives does not offset the gains that they could get. I think that, and I think what they're also saying, though they haven't said this directly, they see that quantitative easing kind of does about the same thing. Why they don't like it that much, it's a known quantity. They know what they're getting at, and that's what they'd rather take. That's where they'd like to focus their attention. They've also talked about, I guess, yield curve control. They have talked about that. So if they were going to go down another policy route that they haven't used before, that's probably where they would go. To me, going into negative interest rates is something that if at all, you're going to have much more problems if they ever go down. They just don't, they seem to say no to that. And I don't think that's going to change for some time. Right.
I think it won't be an understatement to say that the biggest issue, I think that with international ramification relates to trade. I think whether it is tariffs, TPP, or with respect to China. So between the two candidates, I think the approaches could be somewhat different. But more broadly on trade, I think we all know that President Trump had pulled out of TPP. He also renegotiated the NAFTA agreement and also introduced tariffs and non-tariff restrictions on Chinese imports under the America First policy. So how different would Mr. Biden's approach would be in dealing with the tariff and technology issues with China? I just read it in Reuters this morning that his top advisors are saying that if Biden is elected, he'll consult other US allies on the issues of tariffs, China. So what should we make out? Where should how should the tariff approach how would the tariff approach of Mr. Biden differ from what Mr. Trump has been doing so far?
I think so. I think that if President Trump is reelected, my expectations is he will continue the America policy first. It'll be a unilateral, approach against China. He will not try and pull allies with him. So this policy that he has right now will continue. I also am concerned under Trump on the trade situation is that President Trump may extend tariffs to other countries. For example, you know, he could use currency manipulation against Vietnam or such. So I don't think so. I would suspect that with President Trump, he would continue his fight against China, but it could move into other territories as well. For President Biden, I don't think he's going to pull back on the tariffs that are in place right now. I think he's going to leave them there for now. You know, again, it is a little bit of a pressure on China to move so. But I think President Biden, if he is elected, his action will be threefold. One is that he has talked about basically a coordination with a coalition, if you will. He wants to bring, if he wants to fight the trade dispute with China, why doesn't he get more members of the army who share equal concerns about China's trade policy? Bring that coalition, becomes much more strong against moving China in terms of policies that would be more friendly to the U.S. and other countries. That's one thing he says. He's talking about going back to TPP. That could be a win, and where he's talking about changes there, labor and environmental regulations. We had earlier thought that the TPP plan, when it wasn't negotiated under President Obama, was pretty good for the U.S. So in my sense, the adjustments that maybe Biden will ask will still be on a positive side. I think another factor that he's moving into would be, he has talked about, again, on the regulation side, he's talked about moving into, he's talking about a carbon tax at the border. That could also play into the China dispute as well. But it goes in line with what the EU is saying. So in some ways, that also is a unified front.
So I think we're getting a lot of questions on the US dollar. I mean, so where is it likely to go post-elections, at least directionally? I think what could be the pressure points on that? I think, would you like to take that question, I mean, on the dollar?
On the US dollar,
yeah.
The funny thing is with the US dollar, I think about when S&P Global downgraded the United States, what did we see there? You know, you'd think that's increased amount of uncertainty, a lot of worries, etc. What we ended up seeing is the dollar gets strong and U.S. interest rates go down to historic levels, and we're talking World War II historic levels. The U.S. economy is still the safe haven, the safe haven for the world. When the U.S., even if the U.S. causes the problems, the U.S. is still the beneficiary. So I suspect what we would see, particularly we saw it in the trade war, if that heats up, what did we see? Money go into safe haven U.S. treasuries. The dollar got stronger, treasury yields went down lower. I suspect that wouldn't change.
All right. I think now the other question, which is I think in the minds of most of the people, particularly from the markets, is that I mean, what would happen to the markets, capital markets, the financial markets under Trump versus under Biden? I mean, is the outcome likely to be similar, or I mean, are we likely to see two completely different directions emerge?
Well, there's two ways to take it: near term, and I don't know if that's what they're thinking about in terms of who wins. What will be the impact on markets near term or long term? So
near term is what people are most concerned about.
So near term, one thing to keep in mind is I think that given that the polls have been saying that Biden will win, it looks like markets have already priced that in. And it seems that markets, we know that the historical position has been that the rule of thumb is always that Democrats are not good for businesses. Republicans are much more friendly, business friendly, and that's certainly the case. When you look at, for example, regulations, President Trump was very much about deregulation. That was a big boom for energy companies, for example, in the United States, and for the financial markets. President Biden is talking about removing some of that deregulation, going back to the Clean Air Act, for example, and also shifting energy policy more towards green friendly policies. So in that sense, if there was a Biden win, I suspect, if I were taking it by a sector analysis, I suspect that the energy companies might be a little bit more challenged. Biden is talking about removing some of those subsidies to energy companies, for example. So I could see some challenges there if there was a Biden win. But overall, the overall markets, what we're expecting and what seems to be the case is that markets also see less uncertainty with the Biden win, fewer tweets, let's put it honestly, what we could expect, fewer tweets that can confuse markets, and also the stimulus that President Biden is talking about will then relieve markets in the worry that a double dip, that the risk of a double dip would be waylaid. So I think near term markets are saying if it was a Biden win, that means more stimulus to prop up the economy, avoid a double dip, and less uncertainty in terms of confusion. And third, worries about changes to regulation and tax policy. Oh, that's far out. That's a year away. We don't have to worry about that right now.
Right. So I think now let's talk a little bit about infrastructure. I think you had also mentioned it in your presentation. I think it's we all know that infrastructure spending is the best way to stimulate the economy and to raise the growth potential. Now, how are the approaches of two presidents different with respect to infrastructure? I mean, do they have specific focuses on specific types of infrastructure, or I think, could you throw some light on that?
Sure. So Biden, when I look at the two policy proposals, Biden is much more clear. Again, first of all, it's going to change. Whomever is elected, whatever they're saying now, you can make. There's going to be lots of tweaks and changes to it as well going forward. But overall, in the Biden plan, what we're seeing there, he's talking about a huge bill, $2 trillion, which funnily is what and again, there was just a pure coincidence, we at S&P Global had done an analysis of the impact of a $2 trillion investment spend. We did this in May. And what we saw there with the $2 trillion investment spend, what we saw was that it would add to the economy over a 10-year period. It would add about $5 trillion to the economy with a multiplier effect of 2.7, meaning for every dollar spent, you get $2.70 back in economic activity. Pretty nice win. But that does matter. That also, the assumption is that those projects that are in place would be wise ones, meaning productivity generating. On the Biden proposal, again, we'll see. But governments, always mess it up and make it more of a, kind of a not necessarily a productivity win. But under the Biden proposal, he's talking about a $2 trillion investment in infrastructure. He kind of is covering the gamut. Of course, roads and bridges. He's talking about building a kind of infrastructure to protect. We have another hurricane down in the south in the United States. The hurricanes there have been so frequent. We've now gone into Greek symbols in order to have names. We've gone through the alphabet already, and so in that sense, that could be a win. He's also talked about other things, but anyway, President Biden has a much more large gamut. For President Trump, he's talking about broadband, 5G, for example, to get that much more expanded across the US, a positive move. But the worry with President Trump is that I suspect if he does win, I don't think he's going to carry, the risk is he won't carry the House. He may carry the Senate, but he won't carry the House. That means a gridlock Congress. It's going to be much harder for President Trump to get something through. If Biden wins, he could have gridlock, but it seems less likely.
Well, just got a follow-up question on infrastructure, which says that, well, I think it's a good idea to spend, but how are they going to fund it?
Well, in terms of infrastructure spending, that's true. It is going to be expensive. $2 trillion near term is a good amount. Well, remember, first of all, it goes over a 10-year period. So he's not spending the $2 trillion right off the bat. He's talked about the tax package. He's talked about raising rates. That is one thing that actually could help in terms of funding both the infrastructure spend, but also dealing with the debt going forward. Right now, I guess right now the fiscal deficit is over $3 trillion. Something needs to be done. First of all, we need to have the economy get back to health, bring those people back to the workforce, get the businesses working strongly. And if they're working strongly, they get revenues. If people are hired, they get taxed. They also get wages. All that is taxed by the government. So that also means that when the economy gets healthy, the money starts to come back. But it is true to this person's comment. It is true that over the medium term, near term is, look, we got to get to the bridge. We got to to get that bridge so we can all get to the other side, past the virus. But once that's happened, those are real questions for policymakers, but that's a medium-term question going forward.
Right, right. I think one of the issues that is dear to Indians as well, I think, but you also touched about it in your presentation. I think there was a nice slide, I think, which you didn't show it, the last slide. What is the difference in approach of immigration to immigration of the two presidential candidates? I mean, and what kind of impact does it have on US economy?
So we had talked about immigration reform, gosh, in a few years ago. And what we had said then is that we understand that for some, that, you know, having immigrants, either undocumented workers or legal immigrants coming to the US, that could challenge somebody's job, you know, that they could be replaced. Yeah. Some substitution effect. But we do think that for the most part, immigrant employment is a complement, not a substitute. Indeed, what we see in terms of immigrants who come to the U.S., whether it's undocumented workers or legal workers, they're filling the needs that either U.S. citizens do not want to do, particularly agriculture, for example, and more low-paying jobs. Although that's, you know, that's still, there is some people who would be challenged and would be at risk. And on the high end, some jobs that the U.S. population don't have the skills to do, particularly high-end, very much technologically driven skills. So in that sense, we see it as a complement, not a substitute. Where we see immigration policy in the U.S., it's been this historically, it is largely family-based. I did that chart that I was going to put up that I didn't want to go on too long because I wanted to get to more questions. What it would have showed you is that immigration visas in the United States, over, I believe it's 66% of the visas that the U.S. government issues, and this is like, the most recent data that we had, are family-based. That means grandma, the kids, and all the whole family comes into the U.S. fine enough, and they probably all have jobs, or many of them may have jobs. But what we thought would be kind of what would be an interesting and a gain for the U.S. economy if we moved the needle just a tad towards a focus on employment-based immigration, largely tied to H-1B visas and the such. Right now, employment-based visas that are done are under 10%, and this was an earlier number. This is coming from 2013 numbers. I suspect it's even lower under President Trump. If we move that needle a little closer to more employment-based immigration, we would get those numbers that I talked about, where we would have a 30% gain, 30 basis points is added to growth going over for the next 10 years.
All right. I think, so let's try to, I think some people are talking about a complete blue wave also. I mean, if that happens, so, I mean, what would be the policy scenario, the outcome for the economy and the markets in the short and the medium run, if that indeed plays out, if we have Democrats in both, controlling both the houses?
I think the near-term unity means less uncertainty, and it also means more policies get through, less gridlock. When you're going through a very soft and challenging recovery, where the risk of a second recession is not small. Even mine, 35, or others are around 30. So it's not small. I think that would be a comfort to markets, meaning that more policy will get through. I think that markets will be focusing on the near term. They're going to be focusing on the stimulus will get through, meaning the risk of a recession is going to be waylaid. If indeed more policy gets through, and under a unified government, that would be the case. The issue of taxes and regulation are a concern to markets, but because they see that not, a couple years down the line, and that would also be when another election comes due, they may see that as a maybe or not at all. Meaning that, as a president, they have the first year, if you have a majority in Congress, you have a lot more leeway to get policy out. But as you approach the midterm elections, which is 2 years later, the president has to be very careful about the political points he uses up, because that may not hurt him but it's going to hurt his constituents. It's going to hurt his policymakers in his party for re-election. And he'd like to carry that majority over to the next 2 years. So in that sense, I think markets are betting that as we get closer to the midterm elections, taxes and some of that regulation, re-regulation that Biden has talked about might be not as intense as what he's saying during his campaign.
Okay, so let's take the last question, which is quite interesting in a way. Historically, I mean, have the policies or the behavior of presidents changed in their second term? I mean, so somebody is curious to know.
Have they changed in their second term?
Yeah, I mean,
in your second term, there's a couple of factors that would be at play. The one, it depends on how their policies change. It's going to depend on the makeup of Congress. You can't get your policy out, no matter how much it changes, if you don't have a Congress that will ratify it. I think in terms of, so that's one thing. But the second thing is, it's your second term. You're not going to run for re-election. So you do have a flexibility, meaning that you don't have to be reelected. You can do what you want in that sense. So you do have that relief of not having to worry about being reelected, but at the same time, it really does depend on the congressional makeup. And if you have a gridlock Congress, no matter how much you want to get those things through, and you have much more flexibility because you're not running for another term, you still have to deal with the fact that the congressional makeup will basically hold you back. I think Trump may feel a little bit more free because he doesn't have to worry about reelected, but I do think he's going to be held back by gridlock in Congress. That means I suspect his actions will be a lot of executive orders like he's done in the past. And so that you can expect to see a bunch of those written.
So with that, we come to the end of the webinar. If anybody has any, there's a feedback poll, please, I think, do punch in your feedback. But if anybody has any questions which they want answered, I think please do send them to us and we'll try to get an answer for that. And last but not the least, I think thanks very much, Dr. Bethan, for taking time and answering so many questions, diverse questions, so patiently. Thank you very much for making time for us today.
My pleasure, DK, and hopefully next time I will be in your country to do it again.
Well, look forward to that.
Me too.
Okay. Bye.